I'm John A.G., and this is the Collapse Files. The United States government now pays more in interest on its debt than it spends on national defense. In fiscal year 2024, interest payments reached $892 billion. The defense budget was $874 billion. For the first time in modern American history, servicing debt costs more than protecting the nation. That number isn't theoretical, it's not a projection. It's already happened. And it's accelerating. The national debt stands at $36.2 trillion as of January 2025. The average interest rate on that debt is 3.13%. Every quarter point increase in that average costs an additional $90 billion per year. The 10-year Treasury yield currently sits above 4.5%. New debt is being issued at rates 40% higher than the average, which means every dollar borrowed today costs more than every dollar borrowed yesterday. And the total keeps compounding. This is not a fiscal policy debate. This is not about political preference or economic philosophy. This is about arithmetic. When interest payments exceed defense spending, you are no longer funding a future. You are financing a debt spiral. And here's the part that matters. This exact pattern has occurred before. Not once, not twice, repeatedly across history. Rome in the 3rd century, France in 1788, Weimar Germany in 1921, Argentina in 2001. The sequence is always the same. First, the interest payments grow. Then, confidence in the currency fractures. Then, the system breaks. So, the question is not whether the United States will face a debt crisis. The question is whether the institutions managing the world's reserve currency understand they are already inside one, and whether the bond market still believes they can manage their way out. To understand what's happening now, we need to establish what's happening in the bond market, the place where government debt is priced, traded, and ultimately trusted or rejected. Since mid-2023, something abnormal has been occurring in the Treasury market. Yields have been rising even as the Federal Reserve signals rate cuts. The 10-year Treasury yield, which serves as the benchmark for all long-term borrowing costs in the economy, hit 3.32% in April 2023. By October 2023, it reached 5.02%, the highest level since 2007. It has since moderated but remains elevated, trading between 4.2% and 4.7% throughout 2024 and into early 2025. That's a 70 basis point range, but the trend is unmistakable. Yields are staying high despite the Fed's pivot toward easing. Here's why that's statistically abnormal. Historically, when the Federal Reserve signals it will cut rates, long-term yields decline in anticipation. The market front-runs the policy. Bond prices rise, yields fall, and borrowing costs ease across the economy. That transmission mechanism has been reliable for decades, but in late 2023 and throughout 2024, the opposite occurred. The Fed began cutting rates in September 2024, reducing the federal funds rate by 100 basis points over 3 months. During that same period, the 10-year yield rose from 3.62% to 4.57%, a 95 basis point increase. The central bank is easing and the market is tightening. That divergence is not normal. It signals a breakdown in the relationship between monetary policy and market expectations. Now let's add the fiscal side. The U.S. government ran a deficit of $1.83 trillion in fiscal year 2024. That's 6.4% of GDP during a period of economic expansion and near full employment. Historically, deficits of this magnitude occur during recessions or wars. The fiscal year 2009 deficit, in the depths of the financial crisis, was 9.8% of GDP. The 2020 deficit, amid pandemic lockdowns and emergency spending, was 14.7%. But those were emergencies. The 2024 deficit occurred with GDP growth above 2%, unemployment at 3.7%, and no major crisis. The government is borrowing as if in emergency mode during peacetime and growth. That's structurally unprecedented. The bond market is responding accordingly. Total Treasury issuance in 2024 exceeded $23 trillion when including rollovers of maturing debt. The Treasury Department issued approximately $9 trillion in new and refinanced debt to cover deficits and maturing obligations. The majority of that issuance occurred at yields between 4% and 5%, significantly higher than the 1% to 2% rates that prevailed from 2020 to 2022. Every dollar of old debt maturing and being refinanced locks in higher interest costs for years or decades, depending on the maturity. The weighted average maturity of U.S. debt is currently 6.2 years. That means over the next 6 years, the majority of outstanding debt will roll over at today's higher rates, and interest costs will continue rising even if the Fed cuts short-term rates to zero. Here's the mechanical reality. Interest payments in fiscal 2024 were $892 billion. The Congressional Budget Office projects they will reach $1.4 trillion by 2034 if current policies continue. But that projection assumes the average interest rate on the debt rises to only 3.6%. If the average rate reaches 4.5%, In line with current 10-year yields, annual interest costs exceed $1.6 trillion within a decade. At that point, interest payments alone would consume 32% of federal tax revenue, assuming revenue grows at historical rates. That leaves less than 70% of revenue for everything else: Social Security, Medicare, defense, infrastructure, and all discretionary spending. The math doesn't work. Something has to give. To understand where the system is failing, you first need to understand how it's supposed to work. The Federal Reserve controls short-term interest rates by setting the federal funds rate, the rate at which banks lend reserves to each other overnight. When the Fed raises this rate, it makes borrowing more expensive, which slows economic activity and reduces inflation. When it lowers the rate, it makes borrowing cheaper, which stimulates activity and supports growth. That's the theory. In practice, the Fed's control extends primarily to short-term rates. Long-term rates, like the 10-year Treasury yield, are determined by the market based on expectations of future inflation, growth, and risk. The transmission mechanism works like this. If the Fed signals it will cut short-term rates, the market expects lower inflation and weaker growth ahead. Investors buy long-term bonds to lock in current yields before they fall. That demand pushes bond prices up and yields down. The yield curve, short-term rates versus long-term rates, flattens or inverts. Borrowing costs decline across the economy. Credit eases. The system responds. But this mechanism depends entirely on credibility. The market must believe the Fed can control inflation. It must trust that rate cuts won't reignite price growth. It must have confidence that the dollar will hold its value over time. When that confidence erodes, the mechanism reverses. If the market believes the Fed is cutting rates prematurely, or that inflation is not truly under control, or that government borrowing is unsustainable, investors sell long-term bonds. Prices fall, yields rise, the yield curve steepens, and the central bank loses its ability to influence long-term borrowing costs, even as it cuts short-term rates. That's what's happening now. The Fed has cut rates by 100 basis points since September 2024, but the 10-year yield has risen by 95 basis points over the same period. The transmission is broken. Now identify who is trapped. Start with the government. The U.S. Treasury must issue approximately $9 trillion in debt annually to cover deficits and refinance maturing obligations. If yields remain elevated, every dollar of new borrowing costs more. If yields rise further, the interest burden accelerates beyond the government's ability to service it through revenue alone. The Treasury is trapped between fiscal necessity and market pricing. It must borrow, but it cannot control the rate at which it borrows. That control has shifted to the bond market. Next, the banks. U.S. commercial banks hold approximately $4.4 trillion in securities, the majority of which are Treasury and agency bonds. When yields rise, the market value of those bonds falls. Banks that purchased bonds in 2020 and 2021 at yields near 1% now hold assets worth significantly less than their face value. This creates unrealized losses. As of the third quarter of 2024, U.S. banks held an estimated $515 billion in unrealized losses on securities portfolios. Those losses don't appear on the balance sheet as long as the bonds are classified as held to maturity. But if depositors withdraw funds and banks are forced to sell those bonds to raise cash, the losses become realized. That's exactly what happened to Silicon Valley Bank in March 2023. Deposit outflows, forced asset sales, unrealized losses became real, and the bank collapsed within 48 hours. Then there are the pension funds and insurance companies. These institutions are structured around long-duration liabilities, promises to pay retirees or policyholders decades into the future. To match those liabilities, they invest heavily in long-term bonds. When yields were near 2%, pension funds struggled to meet their assumed return targets of 7% to 8%. Now, with yields above 4%, the math has improved slightly, but the transition period, the years when bond portfolios lost value as yields rose, has created a funding gap. Many state and local pension funds are underfunded by 20% to 40%. Rising yields help future contributions, but they don't erase past losses. The funds remain structurally short. Finally, consider foreign holders of U.S. debt. As of October 2024, foreign governments and institutions held approximately $8.1 trillion in U.S. Treasury securities, about 22% of total debt outstanding. Japan is the largest holder at $1.13 trillion, followed by China at $816 billion. Both have reduced their holdings significantly over the past decade. China's peak holdings were $1.32 trillion in 2013. Japan's peaked at $1.3 trillion in 2021. The selling has been gradual but persistent. Why? Because holding U.S. debt now carries more risk. Currency risk, as the dollar's purchasing power erodes. Political risk, as sanctions and asset freezes become geopolitical tools. And opportunity cost, as higher-yielding alternatives emerge in other markets. Foreign central banks are not dumping treasuries in panic. They're quietly reallocating. And that reallocation removes a structural buyer from the market, which means the Treasury must find new sources of demand or accept higher yields. This is the trap. The government must borrow. The banks cannot afford higher yields without risking unrealized losses. The pension funds are underfunded. The foreign buyers are stepping back. And the Federal Reserve, which could theoretically step in to buy bonds and suppress yields through quantitative easing, faces a different constraint: inflation. If the Fed resumes large-scale bond purchases, it injects liquidity into the system, which risks reigniting inflation, the very problem it spent 2 years fighting. The central bank is trapped between price stability and financial stability. It cannot solve both with the same tool. Let's compare what the official narrative says versus what the market signals are showing. The official position, as stated by Treasury Secretary Janet Yellen and Federal Reserve Chair Jerome Powell, is that U.S. fiscal policy is sustainable, the debt trajectory is manageable, and the economy remains resilient. The data shows otherwise. Start with the debt-to-GDP ratio. U.S. federal debt held by the public is currently 97% of GDP. Total debt, including intergovernmental holdings, is 123% of GDP. Both figures are at or near all-time highs outside of World War II. During the war, debt peaked at 106% of GDP in 1946, then declined steadily for 3 decades as the economy grew and deficits shrank. Today, the debt ratio is rising during peacetime, and the Congressional Budget Office projects it will exceed 180% of GDP by 2054 under current law. Now compare interest expense to revenue. In fiscal 2024, net interest payments were $892 billion. Total federal revenue was $4.92 trillion. That means 18.1% of revenue went to interest. In 1990, interest consumed 14.7% of revenue. In 2000, it was 12.5%. In 2020, it was 8.1%. The trend has reversed sharply, and this is at an average interest rate of 3.13%. If that average rises to 4%, interest as a share of revenue exceeds 23%. At 5%, it approaches 29%. No major economy has sustained interest payments above 25% of revenue without restructuring debt, cutting spending dramatically, or inflating the currency. Compare regional bond yields. The 10-year U.S. Treasury yields 4.57% as of January 2025. The 10-year German Bund yields 2.43%. The 10-year Japanese government bond yields 1.07%. The 10-year UK gilt yields 4.64%. The US and UK are outliers. Now examine the difference between official inflation and market-implied inflation. The Consumer Price Index rose 3.4% year over year as of December 2024. Core CPI, which excludes food and energy, rose 3.9%. Those are the official figures. But the bond market tells a different story. The break-even inflation rate, the difference between nominal Treasury yields and Treasury inflation-protected securities yields, sits at 2.4% for the 10-year. That suggests the market expects inflation to average 2.4% over the next decade. But here's the contradiction. If the market truly believed inflation would return to 2% and stay there, the 10-year yield would not be above 4.5%. A 4.5% nominal yield with 2% inflation implies a real yield of 2.5%. Historically, real yields on 10-year treasuries average around 2%. A 2.5% real yield suggests the market is pricing in additional risk, either higher future inflation, greater credit risk, or currency devaluation risk. The market does not believe the official story. Compare paper gold to physical gold. Gold futures on the COMEX trade at $2,787 per ounce as of January 2025. Physical gold bars in London trade at $2,784 per ounce. The spread is minimal, just $3 or 0.1%. That's normal. But compare demand. In 2023, central banks purchased 1,037 tons of gold, the second highest total on record. In 2024, purchases remained above 1,000 tons. China's central bank added 225 tons over 18 months. Poland added 130 tons. Turkey added 148 tons. These are not speculative purchases. These are strategic reserve allocations. Central banks are diversifying away from dollar-denominated assets and into hard assets with no counterparty risk. The paper price reflects investor sentiment. The physical accumulation reflects institutional distrust. Finally, compare official reserves to actual liquidity. The Federal Reserve holds $7.4 trillion in assets as of January 2025, down from a peak of $9 trillion in April 2022. The reduction came through quantitative tightening, allowing bonds to mature without reinvestment. But here's the issue. The Fed's balance sheet is still 5 times larger than it was before the 2008 financial crisis. In 2007, the Fed held $870 billion in assets. Today, it holds $7.4 trillion. That's $6.5 trillion in permanent liquidity injected into the system. The money supply, as measured by M2, stands at $21.1 trillion, up from $15.3 trillion in early 2020. That's a 38% increase in less than 5 years. The Fed claims it has withdrawn stimulus. The money supply data shows otherwise. The liquidity is still in the system. It's still circulating. And it's still exerting upward pressure on prices. This pattern is not new. It has occurred repeatedly across history, always with the same sequence. First, a government borrows to fund wars, welfare, or crises. Then, the interest burden grows. Then, the government prints money or debases currency to service the debt. Then, confidence fractures. Then, the system collapses. The specifics differ. The outcome does not. Start with Rome in the 3rd century. The Roman Empire, at its height in the 2nd century, controlled territory from Britain to Egypt. Its currency, the denarius, was trusted across 3 continents. The coin was 95% silver. Merchants in Alexandria accepted it because they knew merchants in Londinium would do the same. But by 268 AD, the silver content had fallen below 5%. The coin looked identical. The imperial stamp was still there, but the metal inside was copper and tin. Emperor Diocletian attempted to restore confidence through the edict on maximum prices in 301 AD, fixing the cost of over 1,000 goods by law. It failed within 2 years. Why? Because you cannot legislate value into a coin that holds none. By the 4th century, the denarius was abandoned entirely, replaced by the gold solidus under Constantine. The empire survived, but the currency did not. France in 1788 offers a closer parallel. King Louis XVI inherited a government drowning in debt, much of it from financing the American Revolution. By 1788, interest on the debt consumed 49% of all tax revenue. The government could not cut spending without triggering unrest. It could not raise taxes without breaking the nobility and clergy, who were exempt. So it borrowed more. By 1789, interest costs exceeded 50% of revenue. The government was insolvent. The Estates General was convened for the first time in 175 years. Within months, the revolution began, the monarchy fell, the currency, the livre, collapsed. It was replaced by the assignat, a paper currency backed by confiscated church lands. The assignat was initially issued in limited quantities, but by 1793, the revolutionary government was printing assignats to fund wars and welfare. By 1796, it took 1,800 assignats to buy what 1 gold franc had purchased in 1790. The currency was abandoned. The system collapsed. Napoleon restored order and introduced the gold franc in 1803. But the lesson was clear. Once interest payments exceed the government's capacity to pay, confidence breaks and the currency follows. Weimar Germany in the 1920s demonstrates the same pattern at a faster tempo. Germany emerged from World War I with a debt burden of 160 billion gold marks, much of it owed to foreign creditors as reparations under the Treaty of Versailles. The government could not pay in gold or hard currency because its reserves were depleted. So it printed paper marks and used them to buy foreign currency to make reparation payments. The Reichsmark, which traded at 4.2 to the dollar in 1914, fell to 48 to the dollar by 1919. By July 1922, it was 493 to the dollar. The government continued printing. By November 1923, the exchange rate was 4.2 trillion marks to the dollar. A loaf of bread cost 200 billion marks. Workers were paid twice daily and spent wages immediately before they lost value. The currency became worthless. The government issued the Rentenmark in November 1923. Backed by mortgages on land and industry, it stabilized within months, but the hyperinflation destroyed savings, decimated the middle class, and set the political conditions for the collapse of the Weimar Republic a decade later. Argentina provides a modern example. Between 1975 and 1991, Argentina experienced 4 currency collapses. The peso ley was replaced by the peso argentino in 1983. The peso argentino was replaced by the austral in 1985. The austral was replaced by the peso convertible in 1991. Each collapse followed the same pattern. The government ran large deficits to fund social programs and subsidies. It borrowed from foreign creditors. When it could not service the debt, it printed money. Inflation accelerated, confidence collapsed. The currency was abandoned and replaced. In 2001, Argentina defaulted on $93 billion in foreign debt, the largest sovereign default in history at that time. The peso convertible, which had been pegged to the dollar at 1-to-1, was devalued by 75% within months. Bank deposits were frozen. Savings were confiscated through forced conversion to pesos at unfavorable rates. Riots erupted. The government fell. The economy contracted by 11% in a single year. It took a decade to recover. The sequence is always the same. Borrow to fund obligations, print to service the debt, inflate the currency, destroy confidence, collapse the system. The United States is not Rome. It is not France in 1788. It is not Weimar Germany. But the mechanics are identical. The debt is growing. The interest burden is rising. The central bank has already expanded the money supply by 38% in 4 years. And the bond market is beginning to price in risk that was previously unthinkable. The mainstream analysis focuses on whether the Federal Reserve will cut rates in 2025, whether inflation will return to 2%, whether the economy will avoid recession. Those are surface questions. They miss the structural issue. The issue is not whether the Fed can manage inflation. The issue is whether the bond market still believes the Fed can manage inflation without breaking something critical. And the evidence suggests that belief is eroding. Here's what most people miss. When bond yields rise despite rate cuts, it signals the market no longer trusts the central bank's inflation forecast. The market is saying, you're cutting too soon, or you're cutting for the wrong reasons, or you've lost control of the narrative. Either way, we're pricing in more risk. Second-order effects follow. If the 10-year yield stays above 4.5%, mortgage rates stay above 7%. At 7%, housing affordability collapses. Now, apply that to commercial real estate. Office buildings, shopping malls, and apartment complexes were financed at 3% to 4% interest rates between 2020 and 2022. Those loans are now maturing and must be refinanced at 7% to 8%. The higher interest cost cannot be passed on to tenants because leases are fixed and demand is weak. Office vacancy rates in major cities exceed 20%. Retail vacancy is rising. Property values have fallen 20% to 40% in some markets. When the loans come due, many properties cannot refinance because the new loan amount exceeds the property value. The property defaults. The lender takes a loss. If enough properties default, the lenders, regional banks and commercial mortgage-backed securities holders, face capital impairment. The losses spread through the system. Here's the constraint no one discusses. The Federal Reserve cannot cut rates aggressively without reigniting inflation. But it cannot keep rates elevated without breaking commercial real estate, housing, and heavily indebted corporations. It is trapped between two failures, so it will attempt a middle path, cutting slowly, hoping the economy can absorb higher rates without collapsing. But the bond market is not waiting. It is pricing in the realization that this middle path leads nowhere. Either inflation stays elevated and erodes purchasing power, or rates stay high and break the debt structure. There is no scenario where both inflation falls to 2% and the debt remains serviceable at current levels. Why does mainstream analysis ignore this? Incentives. The financial media depends on advertising from banks, asset managers, and brokerages. Those institutions benefit from continued confidence in the system. They need people to keep investing, keep borrowing, keep believing. Questioning the sustainability of sovereign debt or the credibility of central banks undermines that confidence. So the analysis stays focused on the near term, the next Fed meeting, the next inflation print, the next jobs report. The structural issue is ignored because acknowledging it forces uncomfortable conclusions. If the debt is unsustainable, the dollar's status as reserve currency is at risk. If the dollar's status is at risk, the entire post-1971 monetary order is at risk. No one in a position of authority wants to say that out loud. Narrative control extends beyond media. Central banks communicate in carefully managed language designed to maintain confidence while preserving flexibility. The Federal Reserve never says we've lost control of inflation or the debt is unsustainable or we're trapped. It says we're monitoring the data, we're prepared to adjust policy as needed, we remain committed to our mandate. That language is deliberate. It avoids panic, but it also avoids truth. And increasingly, the bond market is responding to the truth rather than the language. When bond yields rise despite central bank easing, the signal is simple. Confidence is breaking. Not all at once, not in a single day, but in a slow, grinding process that becomes irreversible once it begins. The implications extend far beyond interest rates. They touch the core of how the modern financial system operates. Start with liquidity. The Treasury market is the most liquid bond market in the world. It trades $650 billion per day. It serves as collateral for repo markets, derivatives, and margin lending. When Treasury yields become volatile, liquidity dries up. Bid-ask spreads widen. Dealers step back. Transactions that should settle instantly take hours or fail entirely. We saw this in March 2020 when Treasury market liquidity collapsed and the Fed had to intervene with $4 trillion in emergency programs. We saw it again in October 2023 when Treasury auctions saw weak demand and yields spiked. The warning is clear. The market that underpins the entire financial system is becoming unstable. Next, consider trust. The US dollar is the world's reserve currency not because of gold backing or legal mandate, but because the world trusts the institutions that issue and manage it. That trust depends on three beliefs. First, that the Federal Reserve will control inflation. Second, that the US government will honor its debts. Third, that the dollar will hold value over time. When bond yields rise despite rate cuts, the first belief is questioned. When interest payments exceed defense spending, the second belief is tested. When the money supply expands 38% in 4 years, the third belief erodes. All three are happening simultaneously. Trust is not binary. It doesn't disappear in a day. But once the erosion begins, it accelerates. Foreign central banks reduce Treasury holdings. Corporations diversify cash reserves. Investors demand higher risk premiums. The feedback loop reinforces itself. What breaks first is not the stock market or the banking system. What breaks first is the assumption that the system is stable. That assumption is what allows pension funds to hold 30-year bonds, banks to lend against real estate, and businesses to plan decades into the future. When that assumption fractures, behavior changes, long-term bonds are sold, credit spreads widen, capital flows shift, and the institutions that depend on stability, pension funds, insurance companies, leveraged corporations, find themselves underfunded, underliquefied, or insolvent. The system doesn't collapse from external shock. It collapses from internal realization that the math no longer works. The bond market is sending that signal now. It is telling anyone paying attention that confidence in the U.S. government's ability to manage its debt without inflation or default is no longer absolute. It is conditional, and conditions are deteriorating. This is not a prediction of collapse. It is an observation of process. The process by which confidence dies is slow, then sudden. The yields rise gradually. The buyers step back incrementally. The refinancing costs compound quietly. Then, one day, the market refuses to finance the deficit at any reasonable rate, and the government faces the choice: default, inflate, or restructure. History shows which option governments choose. They never choose default. They always choose inflation. Because inflation is a hidden tax that can be imposed without a vote. It transfers wealth from creditors to debtors, from savers to borrowers, from the public to the government. And it destroys confidence in the currency entirely. The United States is not facing a debt crisis tomorrow. It is inside a debt trap today. The numbers are not projections. They are current. Interest payments exceed defense spending. The debt-to-GDP ratio is at peacetime highs. The bond market is rejecting the Federal Reserve's policy signals. Foreign buyers are stepping back. The math is compounding in the wrong direction. None of this is secret. The data is public. The Congressional Budget Office publishes it. The Treasury reports it. The bond market prices it. What's missing is acknowledgement. The institutions responsible for managing this system will not admit the trap exists because admitting it would accelerate the loss of confidence they are trying to prevent. So they manage quarter to quarter, meeting to meeting, hoping growth will outrun the debt, or inflation will fall without breaking demand, or some external solution will emerge. History suggests none of those hopes materialize. Rome didn't collapse because it ran out of gold. It collapsed because the currency stopped meaning anything. France didn't fall because of a revolution. It fell because the debt consumed the state and the currency failed. Weimar Germany didn't hyperinflate because of war reparations. It hyperinflated because the government printed money to service obligations it could not otherwise pay. The pattern repeats because the incentives repeat. Governments prefer inflation to default. They prefer currency debasement to spending cuts. They prefer narrative management to structural reform. And they continue down that path until the bond market forces a reckoning. The reckoning is not an event, it is a process. And the process has already begun. Interest costs are rising, confidence is eroding. The market is pricing in risk that was previously unthinkable. The question is not whether this ends. The question is how much confidence remains when it does. Claude is AI and can make mistakes. Please double-check responses.